Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. Soon you're going to hear the episode number, and I just wanted to tell you in advance that I really appreciate you listening to this podcast. It's definitely a passion of mine, real estate investing. I've been doing it my whole life, but I love doing this podcast. I love talking to other real estate investors and just basically chopping it up for 45 minutes to an hour twice a week. This week, I get to do it with Zach Lemaster, the founder of Rent to Retirement. So this is a turnkey episode. We're going to go deep on what turnkey is, the differences between that and other investments, and where they're focusing their business now. Let's get to it. This is episode 183 of Zen and the Art of Real Estate Investing with my guest, Zach Lemaster. Zach is the founder and CEO of Rent to Retirement. I know you've heard about them because they're the nation's leading turnkey investment company. Zach is also a seasoned real estate investor. I just had you create real estate investing. He has a large portfolio of rental properties across multiple markets, including single family, multi, commercial, and new construction. Zach, welcome to the show.
Jonathan, it's such a pleasure to be here. And yeah, I'm excited for the episode. So thanks for having me on.
Yeah, absolutely. I feel like we're always traveling in the same circles. And it's so funny with the podcast. It's like I get to meet people that I've kind of known about or known for so many years. But yeah, I'm really excited to get you on the show, talk a little turnkey. But let's start with your experience. When you were younger, when was the first time that you remember being even interested in real estate?
I can be long-winded, so I'll try to make this somewhat of a quicker intro. But
we have good time.
All right, fair. You made it available. So
yeah.
No, I think the first time I actually heard about real estate or thought about it as an asset class, I always wanted to be a smart investor and or at least savvy with my money, right? And I was always frugal growing up. But I think the first thing that really clicked with me with real estate is actually my father-in-law. He's from Vietnam, came over during the war, fled Vietnam, came to Canada. My wife's from Canada, and spoke no English, shirt on his back, type of thing.
Yeah.
And tried multiple businesses and kind of failed at them. But he eventually, later in life, was able to own a few apartment complexes with him and a few partners. And I remember going with him to some of these, and they were low income stuff, but he really did well with them. And he kind of walked me through the numbers of them, and he was always kind of like, real estate's the way to go. So that was kind of the first experience. And this was when my wife and I were just dating early on, probably 20 years ago. And then at that point, started to think about it more, read all the Kiyosaki stuff, and then started to kind of dive in on some of my own stuff. But that was the intro point kind of for me.
That's interesting, though, because I have had a lot of people on the podcast who are first gen or second gen, and a lot of their parents were in real estate, in some form, and they didn't realize it. And you, as, someone who's traditional American born here, learning from somebody who just came to the country but built a portfolio, it's really interesting because real estate is an asset class that a lot of people, I think, in their family or in people that they know as family, it's been around and people are doing it. It's just like there was no platform like the internet to show everybody. So what was the first thing that really appealed to you? Was it that there was scale to build business there, or was it just interesting real estate in and of itself?
It was just the simple fact of, it was simple. It was that aspect, right? It's this is what we paid for it, and this is how we leveraged it, and really wrapping my head around leverage to begin with. Real estate is a beautiful thing if you think about the concept where you can borrow money from a bank and then own an asset that you have 100% ownership of, and then have someone pay that off for you, the tenant, right? It's like, that's a really cool concept. So the power of using leverage over time. But he just walked through the math with me, and it was about, this much monthly cash flow, right? And he was in there he was hands-on dealing with all the stuff. I saw that firsthand, but just learning the numbers of it. and how leverage works and how cash flow works over time. I thought that was just very interesting. And that concept appealed to me because I believe there was some level of like kind of financial independence if you grew that enough, right? So
yeah, isn't it interesting though that like that's what you learned in the first thing, and now all this year's forward, you have an entire company that deals with turnkey, you're seasoned investor, but really the things that he taught you still work right now. With all the technology and everything out there, it's really the things that like my dad taught me. They all still work. So we use technology to enhance them, but it's an interesting like kind of, especially with what you went in. Turnkeys in general are pretty simple as an asset class. So it kind of goes back to what you learned. You just obviously put a more technological spin on it because it's available for people to see at a higher volume than it was before.
Yeah, I couldn't agree with that more. And the fundamental aspect, I think, because real estate is a beautiful thing. There's so many different ways you can invest in real estate, between being like an active investor with wholesaling and flipping and burring, all these things, right? Or you can be more passive with notes and REITs and syndications and possibly turnkey somewhere in the middle. But yeah, I think really what appeals like our business model is the fact that I think it's a really easy entry point for someone to actually own an asset, but also understand the fundamentals. And I think that's really important because, to your point, the fundamentals of real estate don't change over time, and you're providing housing for people, and that's always going to be a need, right? So the residential aspect of real estate is always there.
Yeah, and I think it's kind of a feel-good thing. If you're buying a property, and as you said, it's pretty simple. You rent it to someone else. They're helping pay down your mortgage and pay off your mortgage, but you're also giving somebody a home, whereas now, of course, there's affordable housing issues in America. I'm curious, though, when you went with him to look at those properties that time, was that before or after your military service?
That was before. Yeah. No, that was, well, it was throughout because he, owned it for many years, but it was in the early stages. It was early on.
Yeah. So that's why I was asking, because I've had so many veterans on, and a lot of them were really started to think while they were either deployed or on base or wherever they were in the military curve, thinking about real estate much. And I see that scaling much more now because it's an asset that you can kind of learn about, read about, and have boots on the ground, your family at home kind of working on while you're on. Were you thinking about it while you were in service?
Oh yeah. Well, that's kind of where it began for me. Yeah. I was thinking about it in school, right? So I went to 8 years of college. I got an optometry degree. My wife's an optometrist as well. We met in school. And then I went immediately into the Air Force because I was on scholarship. But my first house that I bought was a duplex. I used a VA loan, 0 money down. I was very fortunate with that.
Yeah.
So house hacked it, right? And just lived in that for 2 years, moved out of it, kept it as a rental, sold it 2 years after that for a huge gain. Didn't have to pay any capital gains, right? Because I sold it under 5 years and lived in it 2 of the 5.
Yeah.
And, just kept doing that and trading up. So I did that for a long time, like the live-in house hack. And that was kind of my entry point because I didn't have any money when I started. I had a lot of student loan debt, but I just kept going from there.
That's the magic of the VA loan. I think even veterans don't understand that their benefit can extend beyond one house or one unit as well. So it really is important for veterans, don't you think, to kind of understand that benefit going out, or especially while they're in, because now you want to know how to use it and when to use it.
So many veterans, because I speak a lot with the veteran communities and stuff, of course, with my background. But so many people don't understand how a VA loan works, or they own a house and they haven't used their VA loan. And,
exactly.
It's like you can have, because you don't pay PMI, if you're less than 20%, and you can have multiple VA loans as well, at the same time. So it's a huge, powerful tool that if you're, have access to one and you're not using one, you should certainly learn about it and think about it.
Yeah, and the VA specifically is helpful, one, because you said no PMI, and because you can house hack, but you can also get another property. You're not tied to that kind of like FHA, hey, let's do the 1 year cycle move, even though you did it on some form of a cycle, but you don't have to, to kind of go faster. I think it's a really interesting portal. And of course, you can put 0 money down and then explain it. One thing that I think is important, though, for the veterans listening, and then we'll pivot to your experience, is that I think presentation of a VA loan is really important because real estate agents, generally don't know what they're doing. We both knew that from all of our years. I'm licensed, and it's just the presentation of a VA loan to someone who's inexperienced and is a listing agent. They think, oh, you don't have any money. And it's very important to say, no, this is a benefit that I got for my service to the country, and I'm just activating this benefit. And you can't even show proof of funds to say I have money, but this is the benefit that I get. Why wouldn't I use it? I think that's really important.
And then there's also this a little bit of negative connotation around, VA is hard to close because they require these inspections
It's so
and
ridiculous.
stuff.
Yeah. I don't even think FHA is a big deal. I think they both get a bad name. It's like, well, the inspections are going to help. They're just trying to make sure there's really no toxins in the property or things like that.
One other thing too, Jonathan, I have a buddy now that is VA loans are very easy to acquire for other service members. And that's something people don't think about. So he's right as we talk right now, acquiring. He just got stationed in Hawaii. He's acquiring and he couldn't afford to live there with current interest rates, just buying, to buy a house, but he's making it work because he's acquiring a VA loan. Assumable loan at 2.25% interest rate. That's 5 years into, or 4 to 5 years into the principal.
Yeah.
And so it's like, that is way better than, trying to go. So that's an option too that could be really attractive to people.
Yeah. And that's an option that often can be paired with seller finance on the VA loan. You can really kind of wrap these things all together. It's just a great opportunity. So for the veterans out there, carry this conversation along with you, because if you don't understand it, now's the time to kind of get a full understanding. So you make sure you're making the right choices in. So as you got started with the first properties, what did you like and what did you not like about kind of being a new house hacker landlord? Because I think for new people, everyone thinks, hey, it's no problem, I'll just house hack. I mean, house hacking is probably okay for most people, but you still have to be a landlord.
And you have to live in close proximity with your tenants. So there's
I hope you like
aspect.
that.
And there was certainly issues with that, right? I mean, I was younger at the time. I don't think I'd be necessarily open to that at this point in my life. Yeah. But then I was also a landlord that, how can I say this, didn't have a lot of structure. So I kind of just wung it. Maybe I didn't do as many early landlords are. I didn't do as depth of a background check as I should have. And I was a little bit more lax. I just warm body in there. I had a conversation with them. They seemed like nice people. Great. Let's go.
That's very common though. I mean, I think that's something that new investors need to look out for, because you're so excited. Like, this person wants to pay the rent. I mean, they seem nice, meanwhile you haven't done any checks or anything.
And sometimes that works out, but it didn't in a lot of cases. And then you have to deal with, this person owes me money. And I also see them coming and going at that. So that's a mistake I made, but you learn, right? That's part of the process. You learn over time. And then of course the other aspect is, hey, I start letting a tenant be late once on rent, and then all of a sudden they're late every month and multiple late. Yeah. So, I mean, that's what I didn't like about it. But of course, like, I like the numbers because, again, I was able to acquire an asset. A lot of military guys, they come in and they use their BAH and their housing, and, they just spend it on things, and rent being a big part of that. But I was able to just think about the money aspect of it. And I owned a house that I lived for free because the mortgage is an up-down duplex split level, and it covered the mortgage. So I lived for free and I didn't have any rent payment, right? But I also owned an asset that was, of course, going up in value over the time. The tenant was paying the loan down. I had the tax benefits. So like, all those things really combined. So I loved that aspect of it. And I did house hacking twice, I guess. I moved out of that duplex, moved into another duplex, did that once. And then eventually as my started my family, I moved into our own houses, but I kept those rentals for many years. And every year, I tell people this, Jonathan, that was about 14, 15 years ago now when I bought that first duplex. But every single year since then, I bought more and more real estate. I'm not saying I've made money on all real estate and haven't had issues, but I've always kept my nose down and just tried to acquire more real estate. The more I learn about it, the more I learn about tax benefits. And that was that initial trajectory, right? We started investing locally. I was stationed in North Dakota at the time, which is not like a highly sought after market. It was a good cash flow market. And I bought there for 3 or 4 years. And then we started investing out of state. And actually, that's kind of where our business, rent retirement, initiated, because when I bought out of state the first time, I actually bought turnkey. And these were low income properties, multifamily in Southside Chicago. I didn't know any better. They had great rehab, tenants, terrible performance on tenants and management. I dealt with all the typical turnkey things, right? Yeah. And that kind of prompted me to start to build a better process of investing out of state that was the initiation for our company today. So.
Yeah, and I think that it really is a very strong investment when it works for people who are in markets where they're priced out. You're 25 and living in Los Angeles. I mean, you're not getting a property in Los Angeles. So it is attractive. I always worry for people who don't know where they're investing, but you've created something that's more of a vetted slope where like, look, everything's in, you have a lot of due diligence on the properties that people can see. And I think that's really helpful. Did you just slowly build it up over time based on what you were seeing with your own experience, as you were saying, like, hey, well, this is what wasn't working for me. The tenants were bad. I didn't have support here, and then folded into the process to build rent to retirement.
Yeah, what I think, we had that first bad experience and we had to like just deal with it. So it's kind of the school of hard knocks and learn how to build better systems and teams in place. But also market analysis, just understanding, because once you start thinking about investing out of state, which I think is a really good thing for anybody, quite frankly, because it just allows for diversity, but it also allows you to tap into markets where there's probably better opportunity than your local market, regardless of where you live.
Right.
I'm not
if
saying,
not, you wouldn't be looking out of state. If it was right in front of you, you'd be collecting.
And I'm not saying that you have to do this to start, it's quite fine to start locally. Actually, that's exactly what I did. But I think it's at least something to consider. But once you start looking out of state, then it's like, it almost gets daunting because like there's so many places to invest. Where do I go from there? Like what fits my goals? How do I build a team? But we just really made a systematic approach to identifying a market from a macro and microeconomic scale. We want to be in the path of progress. That's why we focus a lot in the Southeast. And today, we like 80% of what we do is new construction, build to rent. When people think about turnkey, they think about a 1930 house that was rehab, right? And like we focus mainly on upper B and A class new construction homes. Yes, the price point's a little bit higher, maybe 250, 300,000, but it's also in the path of progress, much more predictable experiences, better quality tenants, better growth in rents and home prices over time. So, and that's something we learned as well, just empirically, like just less noise, less headache.
You get builder's warranty if it's brand new build, no foundation. Everything's new. So you're not having, your CapEx should be basically zero for 10 years, barring any like weird anomaly that happens, which you should also be at the higher rent for the area too, because it's brand new and doesn't have an old basement or something old. I've found that especially now as people got scared of the market, buying turnkey or rent ready or new construction, very, very smart. It's also a huge leverage on your insurance costs, which are going to continue to go crazy after this latest storm as well. So you've really found a way to kind of package those on. But when you guys started, you weren't doing like all new builds, right? It was kind of everything.
Nah, we did. We had very few, and we were in the way that our company operates is so we do have some new construction stuff that we do in house, but we also serve as a marketplace for other builders and. Like, for example, we've created relationships with some of the nation's largest builders like D.R. Horton, LGI Homes, where we actually work with their wholesale division, which the individual investor would not have access to. But we get better about buying opportunity because as a group, we're able to buy more, and then we can pass those incentives off to the individual investor that normally would only be available to the institutional buyer, right? So when people think about turnkey in general, they're like, you're paying at or above market price. Well, maybe sometimes, right? But that's actually not the case with some of these new construction properties where you can get, 5 to 10% equity out of the gates because you're working with a buying group like us and we have all the pieces in place. But to answer your question, no, we started with lower price points, lower class neighborhoods, rehab stuff. And some of those worked out really well. Some of them had a lot of issues. But quite frankly, I got tired of dealing with my own properties and also investors that were just like, this isn't performing exactly like how we wanted it to. But,
I think that's, the great part of real estate, especially as a landlord, there's lots of great parts, but it's always a wild card. You just don't know what a tenant's going to do. And a lot of times, of course, you guys are running a company, so they get a turnkey and then the tenant doesn't work out. They're blaming it on you via property management. And it's like, well, you still chose the tenant. There's just a lot of dynamics that can go on that are really outside of a lot of people's control for real estate. A tenant loses a job. That's not their fault unless they got fired. Maybe they got laid off. These are things you learn as a landlord. Like you have to kind of be a little bit malleable.
Well, I would just encourage anyone that's thinking about investing in real estate in any capacity to understand that one, this is investing. Investing has risk, right? The stock market is quite volatile. Even syndications, as I know you've seen, Jonathan, over this like past year, there's blood in the streets, right? There's a lot of stuff that there's capital calls, there's some syndicators losing their properties or converting investments to equity, so it's challenging. So just understand, guys, this is investing, right? In any capacity, there's risk associated with anything you do. including doing nothing, right? There's a risk associated with doing nothing with your money. But if you're going to invest in real estate, especially in a scenario where you own an asset, like you almost have to expect that there's going to be variance, and you have to approach it like that.
Yeah.
And we do our best to educate people on the front end, but yes, some people expect like you're going to get mailbox money every month for 10 years. Well, it's an average. If you own 10 houses, some of those will work well. Some of them will overperform. Like some areas appreciate way better than you would have thought, but you don't know that until the future. And some areas underperform, but that's how real estate operates. It's just time heals all deals. I want to remind people of that. You just got to look at it from a long-term standpoint and just keeps, your nose down. We've certainly, we built a very large portfolio that has allowed my family to live a lifestyle today that would not have otherwise.
Yeah.
And that's why I'm very passionate about real estate. But man, there's been some dark moments of this sucks, right? And you just have to deal with it and have that tenacity.
Yeah, I think those are great points, and even more important to note now, because I think if somebody's looking at a turnkey property, like you said, they're like, oh, well, I'm paying a little bit more than I would. But okay, so you want a new investor. Now you want to buy a dump out of state and renovate it with a shady contractor that you don't know because you think you're going to get value add. Like you're going to lose more money on the renovation. So really, I mean, the pitch, not to use the pitch in a bad way, but the pitch of turnkey to somebody is like, hey, look, everything's done for you, right? And you should pay a little bit more because it's done. So maybe the numbers don't look as perfect as this D-class property, but you have something that has no CapEx and is going to appreciate because it's already at the top of the funnel as opposed to the bottom, right?
These are the type of people, and I think that was a great explanation. Again, there's a lot of different ways to invest in real estate, but I always encourage people have a plan, and be honest with your goals. If you're a brand new investor and you are super busy and you want to invest in real estate, fantastic. There's ways to do that. But if you're someone who doesn't have the time or energy to manage rehab or manage a property in general, then maybe be honest with yourself about the best buying. But where turnkey fits for people, easy way to get started, easy way to access deals and diversify out of state, especially if your local market's too expensive. They're not completely passive. Nothing is, but they are on the more passive end of the spectrum. And I think there's a lot of risk mitigated there, right? So you're not having to deal with a lot of...
Yeah, that's what I think it's a lot of risk mitigation on the front. I also think you can still learn. You still have to manage the manager and work with the manager and understand what you're doing as a landlord. But it's definitely more passive than just buying a property yourself and figuring it out, especially in the mechanicals end. And I think that's a really important part of what you're saying about moving to new build, because the mechanicals is where all your profit goes to die. You buy, especially I'm sure in the beginning, this is what you found in turnkeys that are 1930 renovated and it looks great. And then you go in the basement and that furnace is still 42 years old and that breaks in the first month, and that's $8,500, and you were at 126 a month in cash flow. Well, now it's gone. So that is, again, risk mitigation, like you said, which is what I really like the idea of turnkey and rent-ready properties, especially turnkey new builds. Insurance costs, great. And again, you're just hedging your bets on a product that's not going to have as many issues, barring something crazy.
Yeah. So it's all about, having the right plan. And our typical trajectory that we see with a lot of investors, not everyone, because some people just continue to buy, but they usually buy between 3 to 5 properties within over 2 to 3 years.
Yeah.
And then they have and that might be spread across a couple markets. That gives them a very good foundation to have the confidence to maybe do some of their own deals. It's very common for people to do some of their own. And so it's I feel like we're a good entry point. And I've had a lot of people come back 5 or 10 years later and just be like, hey, I'm glad that you, we've actually had people go out and start their own turnkey companies, right? And become almost competitors. But I'm proud to say that we were the entry point for them. And that's actually what makes it, fulfilling and rewarding at the end of the day.
I think it's pretty interesting, though, because if I think about my journey, we were talking about syndications for a little, I didn't invest in syndications till last year, and now I'm in 3 because it suits where I'm at. But I can see that it could be an entry point for someone to go to rent a retirement and say, hey, I got my first one. Then they try it on their own and it's kind of annoying on my own. Then I can see them coming back later when they're more experienced to say hey, well, let me get 3 to 5 more assets. Now I have a better idea how to manage a manager. And I already know that these are set up ready. So I can really see it working for both sets of investors there.
Especially as you look into the tax side, because we'll have people do exactly that, where it's hey, they've gone out and they're actively doing their own deals, which is fantastic. Some of them have even become full-time real estate investors, but it's also they need to acquire more real estate than they can do on their own to do things like the cost segregation studies and the accelerated depreciation simply from that aspect. So you can be a great business operator. There's a lot of active investors that earn great money, millions of dollars through flipping and wholesaling, all these things. But that's an active business. They've got to turn their money. So it's just like, where are you placing your active capital? And so we'll see a lot of people that are even, experienced investors that just want to diversify in a market. They need X amount of houses to have X amount of tax benefits.
Yeah.
And then we help them build a strategy. We even have lenders that will do a 5% down loan on, these are specifically on new construction homes, on up to 5 investment property, true investor loans. So they could like get this huge tax benefit with using one of those, low down payment loans or something like that. So there's different areas for different investors where it possibly can make sense. And we work with the whole gamut.
Yeah. And I do you prefer for someone to kind of know something about the market? I don't think they need to, but I always feel like you guys are in enough markets where it's like, well, I know more. I've been there 5 times. To me, in my head, I'm thinking like, well, that's a better market for you to start out with because you've at least been there, or at least you've gone there. So you have a little bit more knowledge of the area. It's always a hard thing when I see people like new in the forums and they're like, I'm out of state. I'll invest anywhere. Tell me where to invest. It's like, well, I don't know what you want, or if you want to go there at some point to see your property, do you want to? What do you think about those things? Because I think it can really go all ways on that.
I never want, and this is the same thing that we educate our team on, is I never want to be in the position of telling people what to invest in. I always, even though turnkey is a lower entry point, it's an easier entry point where a lot of the work is done for you, including market research.
Yeah.
At the end of the day, look, this is your money. You're investing with it. And I really encourage you to be as educated and sophisticated as you can, which, means understanding the market. Yeah. I always encourage people to visit the market if they can. The reality is most don't.
Yeah.
And that's okay. I still today own properties for many years I haven't actually seen.
Yeah.
And that's okay. But I would encourage you, understand the market, understand a lot of different things about the market, the tax, the legal structure, the price points, and try to pick something that like have some criteria, right? Have some goals going into it and try to, maybe narrow it down to 2 or 3 markets that fit those and then decide between them. And certainly I think once you start investing in an area, whether you like it or not, you start to learn about that area.
Yeah.
But don't be too lazy of an investor on the front end going into it, right? This is a learning process. Real estate is a lifelong journey of investing. And you should be taking all these opportunities to learn about learn how to analyze the market, learn about that market. That's just going to make you a better investor long term.
Yeah. And I feel like that's a better client for you because you don't want someone who's going to turn around a month later and say like, hey, now my cash flow is down already. My taxes went up, $500. And you're like, this is real estate. This is how this works. We explained it. And I think I look at that across the board with syndications and even with people who own short-term rentals. It's like the more that you explain the process and you focus on who your ideal avatar is as a business, the better your workflow is going to be. Have you found that? I'm sure you get, lots and lots of inquiries because people find you, but not everyone's going to be a good fit for what you guys have, right?
Yeah. I mean, I go back to optometry days sometimes. And I know since you're so active in the BP forums, you see all of it, but, the good, the bad, the ugly. But, I think back sometimes to my optometry days, and one of my mentors told me, Zach, you got to be okay with sometimes firing patients.
Yeah.
Because sometimes you have bad patients. And when you're a healthcare provider and you want to provide for people, it's like, that's you want to just like, you're always trying to help them and serve them, but some people you just can't make them happy, right? So we try to ensure that we do our best to educate people on the front end. I tell our team that we're more, we're really not a real estate company. We're an education and communication company, because the more that we can communicate and educate people on the front end, the better we actually serve them. And yes, there is a sense of like the less we have to deal with on the back end, but it's just about setting proper expectations that, again, this is real estate. This is a lifelong journey, and there will be short-term fluctuations and issues. It's not a matter of if, it's a matter of when, and just be prepared for that. Right. But the more prepared we can be on the front end, and better we can set expectations for people and try to vet them a little bit, the less noise we have to deal with on the back end. And that's probably some of the issues that keep me up at night, is when people are just, there's no, and sometimes it's the littlest thing. It's the craziest thing. Like a tenant stop paying rent for 1 or 2 months, and it's all of a sudden it's like it's a scam or it's the end of the world, right? It's like,
yeah.
But that's, again, I digress.
Yeah, but again, it goes back to the point you've been making. Like, hey, look, there is some risk here. Of course, it's supported by underlying real estate that's tangible, which is better than stocks, in my opinion, just because you can upgrade it, you can get them out. There's lots of things that you can do. But these are things that people need to be aware of. But I think what you were saying was important. You do need to say no to a lot of people. But for people who are new in a business, sometimes it's just like, well, they're offering me the money, they seem good. But I think if you look back at all of like the worst clients, and if I look back at my history as a real estate agent and even as an attorney, the worst clients, I always knew they were going to be a pain in the ass. It was obvious, but I was like doing the scales and I just should have said no. But when you're newer, you're like, oh, we'll take that. And then you'll regret it and hopefully learn from it, right? And that is a hard thing though, because you get a lot of intake, they have to get through the funnel. They seem well vetted. But then there's always a question level, which is what I found as a short-term rental operator. Anyone who asked a question before they booked, I just immediately declined because I already knew they're the person who's like on a 4 or 5 star review in the end. And have you learned over time which ones you're like, I feel bad, but I really have to say no. Like they're already a pain in the ass. And we're not even in due diligence here yet.
And that could be applied to a lot of things, right? Screening tenants.
Yeah,
looking
of course.
At business partners. I've made that mistake quite a lot. That's been painful over the years. Property managers, even looking at properties. So the scrutiny on the front end in any business or capacity, I think would serve all of us well. And yeah, sometimes in the early years, you're eager. So you take it on.
Like you said, reverse it to the investor, the brand new investor. They should be vetting more. You don't take the first property because it's a good deal. You got to kick a lot of tires to make sure you know. And I would suppose on your end, you'd much rather have someone who's asking really smart questions about the markets and properties, because then they're going to pick the right one, as opposed to someone who just says, hey, well, I trust you guys, just do whatever, just send me whichever property you like. That's like when somebody says that as an agent or something, well, just pick the towns that you like. I'm like, I can't pick towns where you want to live. That's insane.
Yeah. It's like, let's back up a sec and remind it, this is an education process. This is your money, right? You got to take control of your money. And to your earlier point, real estate, and I'm not a stock guy or mutual fund. I don't understand it, quite frankly. And real estate, I do. I think it was Warren Buffett who said, invest in what you know and nothing more.
Yeah.
So that's what served us well over time, especially once we maximize the tax benefits and use creative finance and leverage and all these things. You can really get ahead. You have way more control in real estate, but control sometimes also means a little bit more work, right? But you also have more solutions. Like if a stock goes down, there's nothing you can do about it. You buy it or sell it. That's it.
Yeah.
Right.
You can't add a first floor bathroom to a stock. It's just not available. I hope you're enjoying this episode with Zach. Remember, these interludes are all recorded just for the episode. So we're in the middle of Rent to Retirement, the backstory, the nation's #1 marketplace for turnkey, new construction, investment properties. It's a done-for-you turnkey real estate investment company. I hope you're getting a lot out of it. And in the second half, you'll get even more as we deep dive everything about turnkey versus rent-ready. Stick with it. Let's hear more from Zach. Well, so you said before that you do have good relationships with home builders. What percentage of generally your inventory is homes that you guys are either buying or building yourself, or that are conduit relationships?
Well, internally, it's probably less than 10% at this point, just because we've grown in capacity so much. We do just under 1,000 doors a year at this point.
Wow.
And so the majority of those, we obviously have to leverage relationships. So I would say about 80% of what we do is new construction in general.
Yeah.
And that's a combination of working with regional and national builders and being able to, work with their wholesale division specifically, where we can negotiate better deals and access to deals that you can find the same properties on MLS, but if you're buying it from the retail division, and you don't get that, like the volume discount. And then piecing all the things together, right? The lenders, the management, vetting the managerial teams, the insurance providers. There's definitely better insurance on new construction because they're better quality. You know what I mean? So, and we were thankful to see that just with this past Hurricane Helene going through. But so that's the majority of what we do. It's mainly single family or small multifamily at this point. So.
Yeah, let's go through the kind of checklist of what you guys have and what in general just turnkeys provide, because I think for newer investors, or like we said, seasoned investors who are looking for something that's like a little bit easier, let's go through what comes in kind of the overall package, because it's, again, we're balancing that against, hey, do you want to go buy a house out of state on your own and then find everyone, a property manager, a contractor, all these things? What do you get in the bag, with rent to retirement, or, with generally with turnkey that is attractive to people on kind of a more all-in-one basis?
Certainly. And I think you recognize as well, Jonathan, turnkey it's one of these buzzwords out there, like many things, right? Where it's kind of illy defined, or a lot of people try to loop into. So I always want to define like what we mean when we say turnkey.
Yeah,
it's
super helpful.
It's either a house that's been newly built, which is the majority of what we do, or fully renovated, leased, and managed by a team that we've put in place and fully vetted in a market that we've identified to have, successful or likely successful components.
Yeah.
Like such things like landlord-friendly legislation, low taxes, diversity of industries there. We want to see population growth, all these things. And it's a spectrum for each market, right? But those are kind of the key components to be successful over time. In addition to that, like our team, I think where we serve our investors the best is helping them map out a strategy where it's not just like, hey, here's these 30 houses that are available and, we've done our check marks on them and they're okay. Now you got to choose one. It's how do you build a strategy? And again, this is a fine line between telling people what to do versus just making sure they're aware of all the things, all like different lending opportunities. For example, a perfect scenario would be a lot of people just focus on conventional financing because that's what they know. Your 20% they down loan. Well, they're not aware that there's some local credit unions where you can buy properties with less than that, like and not pay PMI, and not have a prepayment penalty because, well, they just haven't known that. So just educating people about all those options and then walking them through, because we have real estate attorneys and CPAs specifically that we work with and we make available to you as well that try to help to give you that tax plan. It's like, how do you scale? Because that's really the key component. A lot of people are, and we talked about this before the show, but a lot of people are, I think, they're nervous or it seems daunting, but it's a mindset thing. They just got to get that first property to get into the game, right? So there's a lot of people stuck at that first milestone. And then you buy a few properties and then you get stuck a little bit in that next scaling of, all right, I've run out of capital.
Yeah.
I have to be a little bit more creative here. Do I have a HELOC? Could I do some cash out refi? Like what other options do I need to raise private capital? And I think that's really where we're able to really help people is like, what are some strategies to scale? And how do you do that effectively? And that's what also allowed us to have repeat clients. So I don't know if I just rambled on or if I answered your question, but
for sure. And I think it, like you're saying, it defeats the myth that people have like, well, this is going to be my outlay on every property. No, there's a system here where you're going to have everything baked in, which includes something that's a more attractive lending product for you here. And I think that's just important to note. That is a very important distinction, though, to define what the turnkey, property is for you, because it gets thrown around as if it encompasses everything. And I've seen a difference between turnkey and rent ready. Rent ready to me is something that could be anything, but it's ready to get rented, but it could have CapEx, you're not sure. Turnkey should have less CapEx in general, just because hopefully all that stuff's been checked. But again, like we were saying, even if you're a client buying into turnkey, you should still be asking those questions. Is the furnace new? Is the hot water heater new? Is the roof new? Have the taxes gone up yet? Those are the things that I think people should ask. And then I think if you have that, as we were saying, as a client, you're like, no, they're kicking the right tires. That's not annoying. That it's like, can you be sure what the population growth is over the next 10 years? That's annoying. I mean, how can you possibly do that? Well, let's go on the side though. Geographically, how are you choosing your markets in the beginning? And then how are you choosing them now, data-wise, scale-wise, industry-wise?
Yeah, I think we started, as many people do, in the Midwest. And I know you know those markets very well. You can have very affordable markets that actually on the surface or in the early years have really good cash flow.
Yeah.
Because you can still buy houses for, 120 to 160,000 all day long. And they're decent homes, right? So that's kind of where we started. And those were good. I think we all got lucky through the 2020 through 2022 period where we had strong appreciation, even in the Midwest.
Yeah.
So some people did very well on those. But, I think where we've kind of transitioned is to be more in growth markets. And I've just learned this over time that being in a growth market, because you really build wealth. I mean, cash flow, everyone wants to think about cash flow immediately because it's tangible.
Yeah.
And they can kind of do the math in their head. It's like, well, if I have $200 a month on this and I own X amount of doors, I can receive, whatever, $6,000 a month. And, you know how to get there. So they think about cash flow. But the reality is like to really build wealth, and cash flow is important, but to really build wealth in real estate, like the appreciation over time is what really gives you that net worth. And then you can trade that in, and cash in on it. And then you combine that with the tax benefits and things like that. It's like it really can give you that hockey stick growth. And we've seen that. So over time, just from our personal experiences, we've kind of migrated more towards the new construction. That's more in the Southeast. So Florida, Texas, Carolinas, Alabama, those are kind of our core new construction markets. So we still have a couple great teams in Ohio and in Missouri that pump out just the bread and butter B-class housing or C-class housing. But I would say about 8% of what we do now today is in the Southeast in those growth markets. And, those things are still doing well year to year. Even they did over the past 2 years with higher interest rates. They still appreciated well. Rents went up. There was some fluctuation just immediately post-COVID, but that's, I think, long term, I think people will end up doing better in those type of assets, even though they may be more expensive to buy on the front end.
I agree. And I think it's a great conversation about appreciation versus cash flow. I was always an appreciation investor because I could be. So I was fortunate like that. But I think too many people are focused on cash flow. And when you're focused on cash flow as a new investor, you're buying a D plus property thinking it's a C. And then you get all the capex in the next year and you don't have cash flow at all. So that's really, if we're talking turnkey, which of course we are, you're looking at it, you're just trying to defeat the disaster scenario where it beats all your cash flow. So would you rather take 300 cash flow knowing that every mechanical and the roof, everything is new for 5 years? Or would you rather risk it for 500 cash flow, but knowing like that furnace is going to break? And again, it's $8,000. And that's what I think people are doing. It's like a new person who comes in and says like, well, I just like to start with Section 8. I'm like, I don't have anything against Section 8. That's a really rough start though, because you're just not going to be ready for what's coming. The building has to be ready for that also. So those are really important parts. I think I remember I said to Henry Washington when I had him on the podcast, I was like, what do you like, cash flow or appreciation? He said, yes. I'm like, that's it. That's what you want, but you just have to be patient. I mean, that's real estate. And if you get an asset, being an asset hunter, if you get an asset that's ready and turnkey, you're in the best spot because you can only really go up. There's nothing barring some crazy scenario that's going to make it go down in this country.
Cash flow happens over time. I think that I agree 100% with all your points. And I would just welcome people to think about a concept of like cash flow improving or happening over time and trying to, it's a chess game, right? Investing and just trying to like anticipate being in a position. So you're not going to retire off of real estate, no matter what you're doing. You're not going to retire off of real estate immediately, right? And you can't, even if you're buying a ton of properties that have, decent cash flow today, like cash flow will happen over time if you understand how the real estate game works, which is, I always encourage people, yes, we want to have positive cash flow. I get that, but invest in good areas that the rents will go up, higher over time. The houses will appreciate. That means your cash flow is improving year after year. That means you have more equity to 1031 exchange and all of a sudden, buy more properties without having to inject more capital into your portfolio. And so just better class assets. I mean, the cash flow just improves over time and your portfolio grows over time. And would you agree with that, Jonathan? Or?
Yeah, absolutely. I was thinking as you were talking, like, if someone is buying in bulk, like which does happen with you guys a lot, you're really hedging your bet. Not everyone's going to be the best, like you were saying much earlier. So if you buy 5 properties, just like if you're off market buying a portfolio, you're not keeping all of them. You're seeing which ones are the best. You're trading the lower ones out for whatever you can, because then you can reinvest into the better ones. And I think that's a good way to think of it, because like you said, they can look at different markets and see what's out there. And if you say you end up with 5 properties to start with, you're not keeping those forever. Like the whole point of real estate is you leverage it. Oh, the market just went crazy. It's worth more than it's ever going to be. Let's sell it. I don't mind when I sell an asset and do well, and then the next person, it goes up for them too. That's a win-win. You're trading the equity sometimes, or you're trading the asset to upgrade into something bigger or better.
Yeah, I think that's so true. A lot of people come into the investing world thinking, and there's nothing wrong with this, but thinking I'm going to hold this property for 30 years, have the loan paid off. And, while that is possible, like there's probably an optimal hold time where you don't experience some of the CapEx yet, and the market has done really well. So don't be afraid. Yeah. Don't be afraid to sell those assets. Right. And then that's, again, making some strategic exchanges can make a big dramatic change in your life. And, don't be afraid to sell some of those assets too. So we see people, they'll hold assets for 3 to 6 years and like sell it and cash in. Right. And then they'll buy 2 more, or maybe they see another market where there's opportunity. We've certainly, done that as well. So that could be a great way to trade up.
But I think if you look just across all of us who do off-market acquisition over the years, and you look at the people who we contact who've owned a property 30 years, the same thing is always there. Their rents are way, way below market value, and they don't care about the property because they've just held it too long. You should have traded it, 15 years ago when you still cared about it so someone could manage it better. Now you have a dumpy property getting terrible rents, so it's completely unattractive in all ways to the investor. So you end up getting way less than you normally would.
Yep. 100%. And that's so true about the mom and pop investor that end up holding them forever because that's what they did. And sometimes that kind of, I think, can ruin real estate for you as well. Sometimes it's good to have a fresh exchange or, trade up into other assets. That's a lot of what we've done. Actually, the majority of what we own right now is commercial retail centers, and those have their own challenges. We still have the residential, and we have some nice high-end short-term rentals, and those have been great as well. But you can also trade up to other assets. A lot of people maybe want to get into multifamily, right?
Yeah.
So, you can think about it like that as well.
Yeah, I think that's a good point, and it goes to your trajectory. I think that as we get older and we get more experience, it's cool to take a little risk. I just, like, if I was brand new, I would focus on one asset. I wouldn't try to do a short-term rental, get a turnkey, get a house hack somewhere, and also invest in self-storage. It's silly, but as you go along, you're like, okay, well, look, commercial retail, which I like as well. I like mixed use a lot. It becomes more attractive because it's not like all of what you learned when you started with your first 2 and you house hacked and then you got more. It's not lost because you're pivoting to something else. It's all part of the same formula to build to there.
I think they call that the shiny object syndrome, right? Where you're bouncing around, and we're all guilty of it from time to time. But if you can stay focused and be successful in one asset class, and generally speaking, I think like single family or small multi-residential real estate is like the best place to start because it's very usually predictable and always in demand solutions with less volatility. But yeah, I would say just exactly like you said, if you can stay focused and really understand that asset class, and it gives you confidence as an investor, and it also allows you to be in a better leveraging position and financing position and just financial overall position to then take a little bit of risk and go into these other assets. I mean, that's what keeps real estate engaging and exciting as you continue the journey.
Yeah, I agree. One more question, because I just thought of it. When you were describing your turnkey, are all of the properties that you guys have, are tenants already placed in them?
Not all, but a good portion. Yeah. There's some properties where tenants are placed.
Well, I guess a lot of new builds, it really depends on the timing of when it's coming up, when the sale is. Yeah, like
builders like D.R. Horton or LGI or Christopher Allen, I mean, they're not going to have tenants because they don't deal with like investors at all. So that will always be after. But, on the stuff that we're doing, or there's, some specific build to rent builders, there's usually tenants in place for those. Yeah.
Yeah. That makes sense. Awesome, man. Well, it was a pleasure to finally get you on here and talk turnkey. I think it really opens people's eyes to the opportunity that's out there. And I think if they could take from what we were saying, if they just do their due diligence and then match it with your guys' due diligence, you're going to be in a win-win situation. You just have to kind of have your eyes open and really work together in a cooperative partnership to get the best out of turnkey, right?
Yeah, it's all about just getting started and learning over time and realizing that this is investing. But guys, real estate in any capacity is just a wonderful investment. If you've been thinking about getting in the game, and you're listening in to Jonathan's podcast, I mean, just get in the game one way or another, because real estate investing has a lot to offer, but you got to be willing to stay committed and go through the challenges, right? So, but thanks for having me on, Jonathan.
Yeah, absolutely. And the best place for people to find you guys is rent2retirement.com.
Yep. We have our own podcast and YouTube channel, put a lot of information out. If you're listening into the car, you can text REI to 33777 to just learn more about our team or set up a call. But we put a ton of information out there, like investment calculators, market data, lending information. So be happy to share that with anyone. And our website is the first place to go.
Yeah. Awesome, man. Well, it was a pleasure. I look forward to seeing you at BPCon. This will come out after BPCon's over, but we're recording on October 2nd and headed out this Sunday. So I'll see you there soon. Great to have you on.
Thank you.
All right. That was Zach Lemaster of Rent to Retirement. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can find out who's coming up on the next episode of Zen and the Art of Real Estate Investing. It's an old school one. My guest is Ginger Faith. Not to say that she's old or I'm old, but we've both been at it for a while. She has a brokerage. She has a long history of real estate investing, and we go all the way back and then we come all the way forward. And we talk about a lot of different things. I think you're going to love this episode. So we'll see you there with Ginger Faith.